Welcome to Commercial Real Estate Pro Network's CRE PN Radio. Thanks for joining us. My name is J. Darren Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today, my guest is Erik Hayden. Erik is the founder of Silicon Valley-based Urban Catalyst, named by Forbes and Sorensen Impact Center as a top 10 Opportunity Zone fund. And in just a minute, we're going to speak with Erik about Opportunity Zone funds and the potential for investors in the next 10 years. But first, a quick reminder, if you like our show, CRE PN Radio, there are a couple things you can do to help. You can like, share, and subscribe. And as always, we'd love to hear from you. Please leave a comment. Also, if you'd like to see how handsome our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Erik. Welcome to CRE PN Radio.
Well, thank you, Darren. Happy to be here.
Yeah, I'm looking forward to our conversation today. Before we get started, if you could take just a minute and share with the listeners a little bit about your background.
Sure. So throughout my career, I've been doing ground up real estate development in the San Francisco Bay Area. In general, I build institutional quality and scale projects. I've done several $1 billion worth of development throughout my career and a pretty heavy emphasis on Silicon Valley and downtown San Jose.
Got it. In any particular asset class that you've worked more in?
I'll tell you, I built a variety of asset classes. Probably the strongest asset class I have as part of my background is multifamily. But I mean, that's been the bread and butter of developers here in Silicon Valley, for over 10 years.
Got it. So let's talk a little bit about opportunity zones. You have a fund and you also do opportunity zones, or do you just have a fund, or can you talk a little bit about how you're
Sure.
structured?
So this is a little bit about what makes us different than other opportunity zone funds out there is we're not just fund managers, but we're also the developers of all of our projects.
Okay. And are these all local to you in the area in San Francisco then?
Yeah, so all of our projects are located in downtown San Jose. We closed fundraising on our first fund in December. We have those projects in downtown. We started fundraising for our second fund here in January, and we have those projects identified in downtown San Jose as well.
Got it. And the essence of the opportunity zone, why don't we touch a little bit on that? I know the basics is the tax advantage, but can you share with the listeners a little bit about what the opportunity is for the investor?
Absolutely. I'll give you a little background on the program. So the program started as a part of the 2017 Tax Cuts and Jobs Act. The federal government wanted to create positive social and economic impacts in lower income areas. And what they did is they designated certain census tracts. Well, at least they said, here's what census tracts qualify that could be opportunity zones. They let the states choose 25% of those eligible census tracts in each state. Here in California, the tracts were chosen in April of 2018. And the way that it works is if a developer, or not even a developer, but if an opportunity zone fund invests into an opportunity zone area, investors into an opportunity zone fund get some special tax benefits. And just kind of taking a step back, in order to be eligible to receive the tax benefits associated with the opportunity zone program, investors have to have a capital gains event. Most capital gains events occur either from the sale of a business, the sale of real estate, or the sale of stock. Here at Urban Catalyst, 70% of our investors, their capital gains event was the sale of stock. If you have that capital gains event and you invest into a qualified opportunity zone fund within 180 days, you're eligible for the tax benefits. And there are three primary tax benefits. The first is you don't have to pay taxes on that capital gains event until you pay your taxes in 2027. The second benefit is when you pay your taxes in 2027, you get a 10% reduction. So for every $100 that you would have owed in taxes, you only have to pay $90. And really the third benefit is the biggest benefit, and that is after investors' money seasons in an opportunity zone fund for 10 years, all of the profits from the fund itself are tax-free. And here at Urban Catalyst, our plan, of course, we're ground up real estate developers. We're going to build these buildings. We're going to stabilize them. We're going to hold them until we get to the end of that 10-year mark. And then we're going to sell our assets. And that's when we return the majority of the profits to our investors. And those profits are tax-free.
Got it. I appreciate you. And that was actually very succinct compared to a lot of the explanations I've got with people I've talked to. So I appreciate that. So the idea is to attract investor funds, identify projects, build the projects, hold the projects for 10 years, then liquidate and return at a substantial tax savings based on the growth. I mean, that's the one that I think that really caught my attention was that growth, the gain on the gain is really the candy there, if I'm understanding correctly. And I'm assuming if you're in an area that's been identified as an opportunity zone, and there's a bunch of funds or a bunch of investment in that area, that the likelihood of that area, appreciating substantially is what we're all planning on. Is that kind of the idea?
I don't think that the goal of the program is to, say have land value appreciate in that area. And there were some studies that showed that in the early part of the opportunity zone programs. I haven't seen as many news articles about it lately, but the benefit is for the people that live in these areas. It's how our ground up real estate development is going to give back to their community. I mean, it's not only designing buildings that the community wants and needs, but for Urban Catalyst, it's things like, we pay millions of dollars in park fees that go towards the construction of new parks. We pay millions of dollars in below market rate housing fees to create below market rate housing. I mean, we have a housing crisis here in California. It's especially true in Silicon Valley, and anything we can do to help alleviate that is a good thing. Of course, in general, the government sees the Opportunity Zone program really as tax neutral. Yes, they're giving some discounts on capital gains when they're not collecting capital gains taxes at the end of 10 years. But if you add up the total amount of real estate taxes that we're paying, we're building these big buildings. And before there were buildings there was something else that wasn't paying as much in property taxes. So you take that property tax increase over the 10-year period, and it really becomes more of a net neutral program.
No, that's again a great perspective. I hadn't thought of that. I think most people I've talked to have been more from a just a pure investment side of things on how to win on your investment strategy and lessen your tax burden. But the the benefit to the community, I mean that's that's going to be huge, especially if you have a lot of investment in an area. I can only imagine that'll attract, well, not just attract, but like you say, it'll be a quality place for people to live and call home, and create more of a community there. In the areas that you're investing in, can you describe kind of what, how large of an area is it, and what was there versus what you're building?
Sure. So in San Jose, there are a total of 11 opportunity zones, and those are just the census tracts. And by the way, when the federal government designated these census tracts, they didn't necessarily reinvent the wheel, right? They pretty much said every census tract that qualified for below market rate housing tax credits is going to be an opportunity zone, or at least qualified for one. So it wasn't some new formula. It was, oh yeah, we already kind of have this. There are 4 census tracts in downtown San Jose that cover almost all of downtown. And all of our projects are located in those census tracts. Downtown San Jose in general, maybe I should tell you a little bit about the story of San Jose, because San Jose, while it is Silicon Valley, And sometimes I get a lot of questions like, well, how did downtown San Jose qualify? Isn't this Silicon Valley? Isn't this, where Google and Apple and all these big tech companies are? And the answer is yes, but San Jose is a different kind of city. It was really one of the first cities to experience urban sprawl. So if it hit its peak in like 1940 as a farming community with a lot of, canning facilities here in downtown generating these high rises started being built, by 1965, downtown San Jose had died and there was not a whole lot left here. The government came in and eminent domain to almost half of the city. They started, really subsidizing development, building parking garages, building infrastructure. Billions of dollars of funding went in, from the public market to make downtown San Jose a place that people wanted to live. But the private markets really didn't catch up to downtown San Jose until about 5 years ago, when we saw this wave of development starting to really come to downtown. And by the way, that was one of the major reasons why we formed Urban Catalyst. It was to take advantage of these macroeconomic trends in Silicon Valley that are all pointing towards downtown San Jose as the next place to do development on a large scale. And for Urban Catalyst, we were going to do business, raise this fund, do our projects. And it was only after I started forming Urban Catalyst that I even learned about the Opportunity Zone program, and that everywhere that we were planning on doing business was already located in an Opportunity Zone. So thought, boy, wouldn't it be great to be able to give our investors these additional tax benefits associated with this program? And that's how we became an Opportunity Zone fund. Seeing this private market catch up with San Jose, I mean, it's been an amazing amount of development, at least potential development coming to downtown. We've seen Google make a massive move into downtown. And I'll give you a little summary of that. In the last 2 years, Google has purchased over $450 million worth of property in downtown San Jose, over 80 acres. And
Wow.
the plans that they've submitted to the city show them building roughly 7.5 million square feet of office and 6,000 residential units. At build out, this will be Google's largest campus on earth. So we're seeing big tech companies come to downtown. And a lot of developers have come to downtown, two in particular, a group called J. Paul. They've spent $650 million on acquisition in the last couple of years. They're going to do, millions of square footage of development. And then even recently, a big Toronto-based development company, Westbank, has come to downtown San Jose. They've spent $300 million in acquisition in the last 6 months. So we're seeing big developers and big tech companies all flooding into downtown. And this is what we saw at Urban Catalyst when we formed. We wanted to really get in on the ground floor, acquire properties, and do ground up development projects before these big developers and big tech companies really drove up the price of the land.
No, that's kudos to you on your timing there to be ahead of all the big guys like that. How many projects do you have in your queue as far as work you're going to be doing?
So in Fund One, we have 7 projects, a variety of real estate asset classes. We have multifamily, office, student living, senior living, and an extended stay business hotel. In our second fund, we have 2 high-rise towers in downtown right next to a mass transit station, really across the street from City Hall, really on the main drag of the central business district. And that's a large office high-rise and a multifamily apartment building.
Gotcha. And will the multifamily be market rate or affordable, or what's the plan for those?
So it'll be market rate. We'll still we'll either pay our below market rate housing fees or we'll build some below market rate housing into the project. San Jose has an inclusionary housing policy, and we're going to meet that policy.
Got it. And how many units do you expect to build between those projects on multifamily?
The multifamily should be, well, in our Fund 2, our multifamily project will be around 350 units. In our first fund, we have a 184 unit multifamily project, and we have our student housing project, which will have 800 student housing beds. So that's they don't necessarily do it by units for student housing; they do it by beds.
Right. So is it like a 3-bedroom or 4-bedroom unit kind of thing with
That's
yeah. No, and is San Jose State, or what's the university nearby for the student housing?
Yeah, it's San Jose State. San Jose State is right in the heart of downtown San Jose, and with 35,000 students, it's the second largest university in the Bay Area behind Cal Berkeley.
Got it. Got it. Well, that's pretty significant. The project have lined up, as well as all the major investors you mentioned that have identified and have come to downtown. And I'm not that familiar with San Jose. I've driven through it. I just remember it kind of being, kind of a continuation. At least it felt like it, between San Francisco all the way down, just around the bay, and kind of the topography. I know there was some high rise stuff, but so is this all down in the downtown core? Is that where this is all taking place?
That's correct. It's all in the downtown core. And, San Jose, it's an interesting city. Like I said, it's the 10th largest city in America, has over a million people. But it's also geographically like a lot like Phoenix, where it's very spread out because of that urban sprawl I was talking about. So the downtown itself only has roughly 75,000 people at night and around 100,000 people in the day when people are working in their offices.
Gotcha. Gotcha.
And the height in downtown is limited by the airport. So the tallest buildings are 220 feet, which is probably why you didn't notice them when you drove through, because 220 feet is like 20 stories. It's not like other cities where you have these, 50, 100-story buildings.
Right. Well, still though, that's a significant, number of units, and just like you said, Google and the others that are coming in there. That I'm guessing that'll kind of really kind of give a facelift to a lot of the downtown area. Is the Google area, is that all contiguous? All the ground that they've purchased, or
Most of their stuff is contiguous, and it's by the Diridon train station, which is slated to be the largest train station on the West Coast.
got it? So there's a significant transit uh, infrastructure already built, or is that going to be developed as well?
So most of the transit infrastructure has already been built, and that was a part of the government's plans in revitalizing downtown over the last couple of decades. The only major change we're seeing is that BART, which is the largest mass transportation system here in the Bay Area, is after 62 years finally connecting through downtown San Jose into Diridon Station.
Got it. No, that's impressive, and again, everything you guys are doing, as well as everybody else. I mean, that seems like just a complete home run, to have an area that has been identified in such a large scale for redevelopment, to get in on that. And while you said definitely the livability sounds like that'll improve dramatically, from an investment standpoint, do you have any kind of idea, what you have a target, or like a prospectus on what you expect the property to, from cost to exit? Is there a multiple there, or any kind of a?
Oh, we have all of those multiples. We don't typically share them in public because of a
Sure.
lot of SEC rules that are associated with raising funds. But
Sure.
I will say that, and to your point, there is risk associated with investing in any type of fund. You got to understand that risk, and there have to be returns that are projected that are adequate to take those risks. And our returns are right in line with where they're supposed to be for the amount of risk associated with our fund.
No, that's great. And you said that the majority of the investors you're finding are coming from stocks. Is that right?
Quite a few. And by the way, I mean, when we're talking about opportunity zones or opportunity zone funds in general, there's a lot of different kinds of opportunity zone funds. A lot of them are focused around ground up development like Urban Catalyst, but I've talked to a lot of funds out there that don't primarily raise their money from stock investors. A lot of the reason why our funds are from stock investors has to do with us being here in Silicon Valley, and really because of the way that we raise money in the market. But I think the most common reason, or at least the largest reason why stock investors are interested in Urban Catalyst or investing in opportunity zone funds, is there's never really been a safe harbor for stock investors in order to defer and reduce paying taxes until opportunity zone funds came along. And now we're really one of the go-to ways to do that while they're diversifying their portfolio into real estate.
Yeah, no, it certainly is a significant opportunity, and I can see that anybody that's been in the market and getting out and looking for a way to shelter some of their gains, it would make a lot of sense. Um,
Darren, maybe I could make a comment about the opportunity zone tax benefits, and that is,
sure.
when most people hear about opportunity zone funds, you hear about the tax benefits. And I mean, obviously, we're big fans of the tax benefits here at Urban Catalyst, but if the biggest tax benefit is you get tax-free profits after 10 years, there better be profits after 10 years, or really what's the point of the whole program? So understanding that underlying real estate and who the developers are that are doing that real estate is really important for an investor to understand when they're looking at a potential investment into an opportunity zone fund.
No, I get it. I get it. Let me ask you, given the start of your fund was, and correct me if I'm wrong, but on the timeline, you were definitely pre-COVID, weren't you, when you started
Yeah,
your?
we started our first fund we opened in February of 2019.
Okay.
We closed our first fund December of 2020, and we opened our second fund here in January of 2021.
All right. So, y- talk about how COVID has changed or modified, or have it's had any kind of an effect on what you see as far as the um, the go forward for you guys.
Sure. So really the biggest impact that COVID had on us initially was the federal government in the middle of COVID, really like in May or June, they said, hey, we need to extend people's opportunity to invest into an opportunity zone fund. So where it used to be, everyone has 180 days from the date of their capital gains event to invest into a fund, it became anyone that had a capital gains event going all the way back to October 4th of 2019 had until December 31st of 2020 to invest. So we had been raising money. People have capital gains events. They call us. They say, we want to invest. We want to diversify. We want to get these tax benefits. And we'd say, great. But suddenly it was no one had any reason to invest now. They all had until December. We thought, okay, well, our fundraising velocity will slow down in the middle of the year, and then we'll have a really big Q4, a huge December. And that's exactly what happened. And so the biggest impact was it just had me, a little bit worried there come around August, September, going, boy, I hope it's a big Q4. And it really came through in a much bigger way than we'd anticipated, which was great. I get a lot of questions about how the designs of our buildings will change because of COVID, or have we rethought, overall our asset classes? Have we changed our program types? And in general, we haven't made significant changes. I mean, we have made some changes as to the types of HVAC systems that we're looking at putting into our buildings so that we can have cleaner air. We'd already planned on having keyless entry, touchless elevators, as really that's the new market. But some of the floor plan layouts of our office, or how some of our amenity spaces or lobby areas in our residential projects work, we've changed those slightly. From a wholesale perspective, when we look at COVID's impact on the real estate market, we have a long-term fund, right? We don't get tax-free profits until after 10 years. So we have a longer-term vision of the overall real estate market. And what we think about is, what is the demand for our tenants? What will be our tenant rents 10 years from now that's going to make the determination of the value of our projects for our investors when we sell? And those rents are really going to be driven by Silicon Valley. So when I think about, changes to COVID, it isn't so much changes because of COVID, because I'm really looking at the long-term trends of Silicon Valley, and if that is going to be favorable, and historically it's been extremely favorable. I mean, in general, Silicon Valley has three aspects that nowhere else has. It has a huge concentration of tech workers. We still get more venture capital funding than anywhere else in the world. And we have, 6 of the largest companies in America either have their headquarters or a major office presence in Silicon Valley. And that's not going to change because of COVID. And over the long term, that's what matters.
No, it's hard to argue with that as far as just the brain trust and the long history that the tech companies have there in Silicon Valley. I'm kind of curious though, and I don't know, sometimes you read stuff and it's more of a national kind of a clickbait, or some sort of a get you to kind of read and make something of it. But you're on the ground there. I want to ask you about some of the information out there about just the political climate, the tax climate in California. Are you seeing? Is there, there's clearly news of companies moving out, but given the long history there, is there any concerns there as far as long term go forward in California?
So really the two things that happened last year that were interesting were California's population declined for one of the first times in like 100 years. And it went down by just a little over 1%. And in the short term, that makes a lot of sense to me because, I mean, if you're not legally allowed to go into your office, I can see one out of 100 people saying, yeah, I'm going to go work from Bozeman, Montana, or I'm going to go work from Austin, Texas. That makes a lot of sense. I really see that as more of a short term thing. Um, the other is, the news of companies leaving, and three in particular I'll point out. Uh, Elon Musk moved to Texas. Oracle said they're going to move their headquarters to Texas, and HP is going to move their headquarters to Texas. So, talking about those three in particular, I mean, Elon moving to Texas, billionaires leaving California so they don't have to pay taxes. That's nothing new. That isn't COVID related. That's just kind of business as usual. Oracle, yeah, that's not a great thing to have Oracle say they're going to move. They haven't moved a significant amount of their office space, but they've moved some. And then HP, man, HP, they really hit their peak, a long time ago. They even split into two companies last year. And what we're seeing here in San Jose is, yes, half of one of their two companies is moving to Texas, and the other one is increasing their office space in San Jose. So from our perspective, we're seeing an increase in workers because of that move, at least locally. To put into a frame of reference, because a lot of the news articles you see about companies leaving, it's sensational, right? They want to get people to read their news.
Right.
That's the way it always is. If you put it into perspective, just the companies that went public in the second half of 2020 in Silicon Valley, in the middle of the pandemic, just those companies have a larger market cap than HP and Oracle combined. So Silicon Valley is still generating these new companies just like wildfire, like they always have. And having a couple of older companies, go to Texas, that's not going to make any real significant impact.
Right. No, I figured as much, but again, the headline news that grabs your attention is the names, the brands, and the names that are leaving, kind of thing. But I think the thing that I think is really hard to duplicate or change is just that the history and the you also have Stanford's nearby, and a lot of the it's just been kind of like the brain trust of all of these um, tech companies are there, and whether that cross pollination or whatever. I mean, that's where those people want to be, and that's how the ideas get started and stuff. And I would just think that would be an attraction for anybody looking for talent or wanting to go where the people are.
To
So
give you another kind of frame of reference, CBRE recently released a study showing that the Silicon Valley office market, or they called it the San Jose metro region, is poised to be the hottest office market in America post-COVID. And what we've seen here in the last 6 months is we've seen a significant number of office building sales. So a lot of these big REITs or big equity investors, they're all coming to Silicon Valley and they're gobbling up office space at, either record or near record pricing in the middle of a pandemic, when everybody's saying, well, isn't work from home going to really impact, the demand for office? And the answer is, here in Silicon Valley, that doesn't seem to be the case based upon the buying patterns of these huge groups and really CBRE's forecasts.
no. No, it makes sense, and I think that COVID certainly demonstrated that there are businesses that can operate effectively or efficiently remotely. But I think that in a creative environment, I'm just kind of hearing from others that a lot of that, the creativity happens when you're, together, as opposed to, everybody's isolated in a spare bedroom or something like that.
You know,
Uh,
the way that it really is shaking out is that people have learned that they can work from home. And if 4% of people work from home before the pandemic, it'll probably be a higher percentage after the pandemic. There
right.
will be some offset as far as like the amount of office space required to socially distance, or some of the new ways that people are thinking that you need to interact in an office. And will those completely offset? I'm not sure, but really that's a short-term thing. And it is here in Silicon Valley, it is the long-term view of how this economy is going to do that's going to drive office. And I mean, that's really what's always driven the office demand here.
Got it. Well, it sounds like, based on what you're talking in the CBRE, what they're reporting, the market seems to be healthy, and as long as the COVID gets under control, which it seems like the numbers are trending that way, and everybody's getting vaccinated and gonna move on. Hopefully, the lights at the end of the tunnel here. So,
That's really what we're seeing.
yeah, gotcha. Hey, Eric, if we could, I'd like to shift gears here for a second. Um, by day, I'm an insurance broker, and I work with my clients to assess risk and determine what to do with the risk. And there's three strategies we typically look at. The first, we look to see if we can avoid the risk. If we can't do that, then we look to see if we can minimize the risk. And when neither of those are an option, we look to transfer the risk. And that's what an insurance policy is. I like to ask my guest if they can look at their own situation, whether it be your clients, the market, investors, the future projects, um, whatever, however you want to frame it. But if you can take a look at that and determine what you think is the biggest risk. And for clarification, I just want to make sure you understand, I'm not necessarily looking for an insurance related answer. But if you're willing, I'd like to ask you, Erik Hayden, what is the biggest risk?
Sure. And this is a great question, because this is what every investor should ask whenever they invest into a property or a fund, is what is the risk versus return? Because that's what matters when you're looking to make your investments. Um, when you look at ground up real estate development, which is really what Urban Catalyst is, you really have to compare it to uh, a group that goes out and buys existing stabilized real estate assets, because you have a much better idea of what you're getting into if you're buying an asset that has a tenant, it has a cash flow, it's already in existence, and if it's a piece of dirt that I'm going to build a building on and there's a whole future. So really in ground up development, there are four major risks. The first is pre-construction risk, and that is, am I going to be able to get building permits and approvals from the city to build the buildings I say I'm going to build? And here in downtown San Jose, that risk is significantly mitigated, really because the local government wants to see development happen. And they're very clear with developers early on in the process, as in way before we enter into the contract to buy the land, say, here's what you can do, here's what you can't do. And they've been really true to their word on that. So as far as other jurisdictions here in the Bay Area or in California, it's not quite as easy in a process. So that risk is much higher in other jurisdictions. Here in downtown San Jose, that risk is significantly mitigated. The next risk that we look at is I call land development risk. And that's, there are things associated with the land that you just can't see. I mean, there's environmental contamination, there's liquefaction, geotechnical risks. There can be underground structures that you don't know about. There can be landslides. There can be water tables, all sorts of stuff. Of course, we do a lot of studies before we acquire any property to make sure that we know everything that we can possibly know. But I'll tell you, one of the reasons why I like doing development in downtown San Jose is because it's flat. I know it's flat. I know that there's a high water table, so I don't build any underground parking garages. And I do all of those studies to make sure I know how to mitigate, build my structural systems for a geotechnical standpoint and my foundations, and how I'm going to clean up any environmental contamination that's associated with the property. I need to be able to put a number in a box, right? You got to understand how much your risk costs. The next type of risk associated with ground up development is construction risk. And this can be a big one. But in order to mitigate that, we do a couple of things. The first is, and this is a bank requirement, every ground development project we do, we need to have a guaranteed maximum price contract with our general contractor. So we use third-party general contractors. And really the way that those work is they say, here's the price we're going to build this building for. And if we go over that price, it's on us, not on you. Now, a couple of caveats to that. The first is it has to be a large enough general contractor that they can handle those cost overruns if they happen. So you can't have them just go out of business on you. The second is they're bidding a set of plans. Those plans better be clear. Your architect, let's hope they didn't forget to put doorknobs on the third floor, because if they did, that cost is on you as the developer. So we have a team of 12 development and construction professionals here at Urban Catalyst, where we have a ton of experience diving through those construction plans to make sure that they're accurate and complete so that we get the best price on our guaranteed maximum price contract. We also, of course, carry contingencies associated with the project so that there are cost overruns, we have money to pay that. And then the last thing is a risk that everybody's going to take, which is market risk. The difference between a ground up development and a project that's existing is we're anticipating what is market risk several years from now, because our buildings take a while to build. So that looking into the future market is that additional risk. We mitigate that risk by doing business here in Silicon Valley, one of the best real estate markets historically in the country, one of the last places to go into a recession, one of the first places to recover. Those are the four types.
No, that's awesome. Very, very well stated there. Curious, you mentioned the speed at which San Jose is willing to work with you on the permitting and stuff. I know that ground up construction usually, takes quite a bit longer than just going and buying an existing building. Do you have any kind of a timeline from acquisition to completion? Do you have a kind of a window that you expect? Is it a year, 2 years, 3 years?
So it depends on the scale of the buildings, and I'll give you kind of a range. It typically takes us from the day that we acquire the building to the day we start construction is between 12 and 18 months. And then depending on the scale, some of our high rises are going to take 2 years, 2.5 years to build. Our smaller projects take 12 months to build. We have a renovation, it's going to take 9 months. So it's a range of time. And then, of course, lease up is different for all of our different product types too, when you're looking at it from a market risk perspective, because it takes about 3 years to get an extended stay business hotel to generate, its long-term revenue. It's just people need to understand there's a hotel there. They start to do business travel. They stay there. They like it. They come back. So it just takes a little while. Same thing with senior living facilities. In general, it takes about 3 years for us to lease up our senior living facility to 100% occupancy. It takes us, maybe a couple years or a year to 2 years to do our multifamily, where our office, we anticipate having a tenant that is going to be able to start paying rent the day that we can have a certificate of occupancy. So it varies from product type to product type.
I appreciate you going through that. I know it's always kind of a wake up call when you see something, and just the time that before any ground work is being done. I mean, trying to get your permits and the architectural plans and all that stuff. A lot of times people forget about that. So I appreciate you sharing that. Hey, Erik, where can the listeners go if they'd like to learn more or connect with you?
Sure. So to learn more about Catalyst, visit urbancatalyst.com.
Got it. Erik, I can't say thanks enough for taking the time to talk. I've enjoyed it. I learned a lot, and look forward to doing it again soon.
Absolutely, Darren. Thank you again for having me.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CRE PN Radio.